Hello, friends. Today's trading psychology video is super important because it's not based on just one book. I've handpicked powerful insights from multiple best-selling books to give you the most practical and effective lessons. When you listen to these topics, I'm sure they'll resonate with your trading journey and help you see the market from a whole new perspective. And hey, I want to hear from you. Drop a comment and let me know which topic you'd like me to dive deeper into. I'll make a detailed video just for you. Also, a quick update. I've been working on some amazing book summaries, including audience favorites like The Psychology of Money by Morgan Housel, Atomic Habits by James Clear, Mindful Trading by Gary Dayton, How to Trade in Stocks by Jesse Livermore, Subliminal by Leonard Mlodinow, and many more. I know many of you have requested these, and due to a busy schedule, I'll be uploading these soon. So stay tuned. Now, without wasting any time, let's dive into today's powerful trading psychology topics. These insights could be the game changer you've been waiting for. If you find value in this video, don't forget to like, share, and subscribe. It really helps the channel grow and brings more content your way. Let's get started. Embrace uncertainty as your ally. In trading, most people desperately seek certainty. They want to know exactly where the market is heading. But as Mark Douglas explains in Trading in the Zone, certainty is an illusion. If you want to succeed, you must accept the unpredictable nature of the market and make uncertainty your ally. Douglas argues that true trading success comes from embracing risk as a natural part of the game, not something to fear. Markets are inherently uncertain. No matter how much research you do, you'll never have absolute control. The sooner you accept this, the easier it becomes to manage your emotions. Here's the catch. Most traders struggle because they want to be right. They believe if they just analyze enough, they can predict every move. But Douglas points out that professional traders think differently. They focus on probabilities, not predictions. Each trade is just one outcome in a series of many. Winning or losing on a single trade doesn't define their long-term success. By accepting uncertainty, you free yourself from the need to be right. You start focusing on executing your plan consistently instead of reacting emotionally to every market fluctuation. This mindset keeps you calm, rational, and disciplined, qualities that separate successful traders from those who constantly struggle. Douglas also emphasizes that embracing uncertainty doesn't mean guessing blindly. It means trusting your strategy and managing risk while staying open to any outcome. When you stop fearing the unknown, you become more adaptable and confident, no matter how unpredictable the market gets. The power of detachment. In Trading in the Zone, Mark Douglas emphasizes a crucial mindset shift, detaching yourself emotionally from individual trades. He argues that every trade should be seen as just one part of a larger statistical picture, not a personal victory or defeat. This mental detachment is what separates successful traders from those who let emotions drive their decisions. Here's the reality. When you get too attached to a trade, every win feels like a triumph, and every loss feels like a failure. This emotional roller coaster leads to impulsive decisions, like cutting winners too soon or holding on to losing trades, hoping they'll turn around. Douglas makes it clear. Emotional attachment clouds your judgment and breaks your discipline. The key is to shift your perspective. Instead of obsessing over the outcome of a single trade, focus on the bigger picture, your overall strategy. Think of trading like a casino. Casinos know they won't win every bet, but their edge ensures long-term profitability. Similarly, as a trader, your goal isn't to win every trade. It's to follow your process consistently because, over time, your edge will work in your favor. Detachment doesn't mean you stop caring. It means you trust your system without being emotionally swayed by short-term results. You accept losses as part of the game and keep moving forward without hesitation. This mindset allows you to stay calm, stick to your plan, and avoid the emotional traps that sabotage most traders. By mastering detachment, you free yourself from the emotional burden of being right on every trade. Instead, you become a disciplined operator, focused on executing your strategy, managing risk, and letting the probabilities play out over time. Losses are your teachers. In The Disciplined Trader, Mark Douglas highlights a powerful truth. Every loss is an opportunity to learn and grow. Instead of seeing losses as failures, Douglas encourages traders to view them as valuable feedback. This shift in mindset is crucial for building self-awareness and breaking destructive habits. Most traders react to losses with frustration or fear. They either blame the market or themselves, which only leads to more mistakes. But here's the thing. If you treat losses as lessons, you gain insights that can improve your future decisions. Douglas stresses that every losing trade reveals something. Whether it's a flaw in your strategy, a lapse in discipline, or an emotional trigger that needs to be addressed. The key is to review your losses with a clear, objective mindset. Ask yourself, did I follow my plan? Was the trade based on logic or emotion? What can I learn from this? By consistently analyzing losses, you identify patterns of behavior that hold you back, whether it's revenge trading, hesitation, or overconfidence. Once you spot these patterns, you can work on fixing them. Douglas makes it clear, losses are not personal failures. They are part of the game. What matters is how you respond. Successful traders don't dwell on losing trades. They extract lessons, adjust their approach, and keep moving forward. When you start viewing losses as teachers, you become a more resilient and disciplined trader. Each setback sharpens your skills, strengthens your mindset, and brings you one step closer to long-term success. Patience outperforms impulse. In Market Wizards, Jack D. Schwager reveals a common trait among the world's top traders: patience. Legends like Paul Tudor Jones emphasize that waiting for the perfect setup is far more powerful than chasing every market move. This idea is simple but game-changing. Impulsive trading drains your account, while patience allows you to strike when the odds are truly in your favor. Here's the trap most traders fall into. They feel the need to always be in a trade. The market moves, and the fear of missing out kicks in. But as Schwager's interviews show, successful traders understand that not every moment is worth risking capital. They wait for high-probability setups, where the reward clearly outweighs the risk. Paul Tudor Jones famously said, "I believe in big opportunities and being very patient." This mindset protects you from overtrading, a common mistake driven by impatience and boredom. When you're constantly chasing trades, you expose yourself to unnecessary risks and emotional decisions. But when you wait patiently, you position yourself to act decisively when the market aligns with your strategy. Patience also means accepting that doing nothing is sometimes the smartest move. Schwager's traders know that the market will always present opportunities. You just need the discipline to wait. This mindset isn't about being passive. It's about being strategic. It's knowing when to strike and when to sit back. By mastering patience, you protect your capital and your mental clarity. Instead of reacting impulsively, you become a focused and deliberate trader, one who understands that the best opportunities come to those who wait. Your ego is the enemy. In The Psychology of Money, Morgan Housel emphasizes a critical lesson. Ego and overconfidence are dangerous when it comes to financial decisions. While his focus extends beyond trading, this idea fits perfectly into the trading world. Ego-driven decisions often lead to reckless mistakes, overtrading, and ultimately, financial losses. Here's the problem. When your ego takes control, you start trading to prove you're right instead of making smart, calculated decisions. You ignore warning signs, hold on to losing trades longer than you should, and take oversized risks to feed your sense of superiority. Housel's message is clear. Overconfidence blinds you to reality, and in the market, reality always wins. Successful traders understand that humility is a superpower. They don't let wins inflate their egos or let losses shatter their confidence. Instead, they accept that the market is bigger than them. No matter how skilled you are, the market can and will humble you if you start believing you're invincible. Housel points out that financial success isn't about being the smartest person in the room. It's about managing your behavior. The same applies to trading. When you trade with humility, you stay flexible and open-minded. You're quick to cut losses, willing to admit mistakes, and focused on preserving your capital rather than proving a point. Ego-driven traders chase the need to be right. Smart traders prioritize staying in the game. The moment you let go of your ego and accept that you'll never control the market, you gain the clarity and discipline needed to survive and thrive in the long run. The routine advantage. In Trading Psychology 2.0, Brett N. Steenbarger highlights a powerful edge that many traders overlook: building strong routines. According to him, structured habits are more than just a productivity hack. They're the foundation for consistency and adaptability, two traits that separate successful traders from those who struggle. Here's the reality. The market is unpredictable, but your process doesn't have to be. Steenbarger emphasizes that having a daily trading routine reduces emotional noise and helps you stay focused, even when the market throws surprises your way. Without a routine, traders often react impulsively, chasing trades, second-guessing decisions, or falling into bad habits. But with a clear structure in place, you create a steady mental environment that allows you to make rational choices. A solid trading routine isn't just about what happens during market hours. Steenbarger encourages building habits before, during, and after trading. For example, before the market opens, review your plan, study key levels, and mentally prepare. During trading, stick to your strategy, log your trades, and stay mindful of emotional triggers. After the market closes, analyze your performance, what worked, what didn't, and what can improve. This kind of routine doesn't just improve technical execution, it sharpens your psychological edge. Over time, structured habits train your mind to respond calmly under pressure. When your process is clear, you don't rely on feelings, you rely on your preparation. Steenbarger's message is simple. Routines create freedom. When you consistently follow a structured process, you eliminate guesswork, reduce emotional bias, and build the mental toughness needed to navigate the unpredictable world of trading. FOMO is a signal, not a strategy. In The Disciplined Trader, Mark Douglas delivers a clear warning. Acting on fear of missing out, FOMO, is one of the fastest ways to lose control and break your trading discipline. Instead of treating FOMO as a reason to jump into trades, Douglas suggests using it as a signal to pause, reflect, and stick to your plan. Here's the trap. When you see the market moving quickly, it's easy to feel like you're missing a golden opportunity. This emotional rush can push you into impulsive decisions, entering trades too late, ignoring risk, or abandoning your strategy altogether. But Douglas makes it clear. FOMO-driven trades are rarely based on logic. They're emotional reactions that often lead to poor outcomes. The key is to reframe how you see that feeling. Rather than letting it control you, treat FOMO as a signal, a sign that your emotions are taking over. When that urge to jump in appears, it's time to slow down and ask yourself, does this trade align with my strategy? Am I reacting out of fear, or is this a calculated decision? If I miss this opportunity, will there be others? Douglas emphasizes that the market is full of opportunities. Missing one doesn't matter if you stick to a system that works over time. Acting impulsively may give you a quick thrill, but it erodes the discipline needed for long-term success. By recognizing FOMO as a warning sign, not a trading strategy, you stay in control. You avoid chasing random moves and remain focused on the bigger picture, following your process, managing risk, and maintaining the mental clarity required to win in the long run. Small wins build big confidence. In Market Wizards, Jack D. Schwager highlights a crucial lesson shared by top traders like Ed Seykota. Small, consistent wins are the key to lasting success. Instead of chasing big, risky trades, these market wizards focus on steady, incremental gains. This approach not only protects their capital, but also builds the confidence needed to thrive in the long run. Here's the mistake most traders make. They want quick, massive profits. But the reality is, aiming for home runs often leads to emotional swings, poor decisions, and big losses. Seykota and other successful traders understand that small wins, repeated consistently, create a solid foundation. Each time you follow your plan and secure a win, you reinforce positive habits and strengthen your belief in your process. Why does this matter? Because confidence in trading doesn't come from luck. It comes from knowing your system works. When you focus on small, manageable trades, you stay calm, stick to your strategy, and avoid the emotional roller coaster that comes with high-risk moves. Over time, these small victories compound into significant gains, proving that patience and consistency beat reckless ambition. Schwager's message is clear. Treat trading like a marathon, not a sprint. Small wins might not feel glamorous, but they provide the stability and confidence to navigate the ups and downs of the market. By focusing on gradual progress, you build the mental and financial strength needed to succeed over the long haul. The mindset of a process master. In Trading in the Zone, Mark Douglas emphasizes a game-changing truth. Successful traders focus on the process, not the outcome. His core message is simple. If you execute your trades flawlessly within a well-defined system, the profits will follow naturally over time. Most traders get trapped by outcome-based thinking. They obsess over whether a trade will win or lose, and this emotional attachment leads to fear, hesitation, and impulsive decisions. Douglas argues that this mindset is destructive because no single trade defines your success. The real key is consistently following your process, regardless of individual results. A process master doesn't let a winning trade boost their ego or a losing trade shatter their confidence. Instead, they focus on executing their strategy with precision. Douglas makes it clear, once you accept that trading is a probabilities game, your job is to stick to your edge without second guessing. If your system has a positive expectancy, meaning it wins more than it loses over time, short-term results don't matter. This mindset removes emotional pressure. You no longer feel the need to be right on every trade. Instead, you measure success by how well you followed your process. Did you stick to your rules? Manage your risk? Avoid emotional decisions? That's what truly counts. By adopting the mindset of a process master, you free yourself from the emotional roller coaster that ruins most traders. You trust your system, stay disciplined, and let the law of large numbers work in your favor. In the long run, it's not about winning a few big trades. It's about executing consistently and allowing the process to deliver the results. The illusion of control. In Fooled by Randomness, Nassim Nicholas Taleb delivers a harsh reality check. Most traders overestimate their ability to control or predict market outcomes. Taleb argues that randomness governs the markets far more than we'd like to admit, and confusing luck with skill is a dangerous trap. Here's the problem. When a trade goes well, it's easy to believe it's because of your intelligence or analysis. But in reality, many outcomes are shaped by factors completely out of your control. News events, unexpected market shifts, or pure chance. Taleb's point is clear. You can't control what the market does, but you can control how you respond. This illusion of control can lead to overconfidence. Traders start to believe they know where the market is heading, which causes them to take bigger risks, hold on to losing trades longer, or ignore warning signs. Taleb warns that this mindset is dangerous because the market doesn't care how confident you are. It moves according to forces no one can fully predict. So, what's the solution? Shift your focus to what you can control. You can't dictate price movements, but you can manage your entries, exits, and risk. This means stick to your plan. Follow a strategy that works over time instead of reacting to every market fluctuation. Manage risk aggressively, control position sizes, and always prepare for the unexpected. Detach from outcomes. Judge your success by how well you follow your process, not by the result of any single trade. Taleb's message is powerful. Humility in the face of uncertainty is a trader's greatest weapon. By accepting that you can't control the market, you free yourself from emotional decision-making. Instead of trying to predict every move, focus on executing your system with discipline. That's how you survive and thrive in a world ruled by randomness. The power of simplicity. In the Little Book of Trading, Michael W. Covell highlights a crucial lesson learned from the world's top trend-following traders. Simplicity beats complexity. Covell emphasizes that overcomplicating your trading system with too many indicators or rules can cloud your judgment and lead to hesitation. The real edge comes from using a simple, repeatable strategy that fits your psychology and allows you to stay consistent. Here's the trap. Many traders believe that more complexity equals better results. They pile on advanced indicators, create intricate rules, and constantly tweak their approach, hoping to outsmart the market. But Covell argues that this complexity only breeds confusion and doubt. When things get messy, you second-guess yourself, overthink decisions, and lose focus on the bigger picture. The best traders keep it simple. They trust a clear process. Whether it's following price trends, managing risk, or sticking to basic technical signals. Simplicity allows you to act decisively. When your system is easy to understand, you avoid emotional decisions and can execute trades without hesitation. Why does this work? Because markets are unpredictable. A complex strategy might work in one situation, but fail when conditions change. A simple system, on the other hand, adapts more easily and keeps your mind clear. Koval's trend followers don't waste time predicting every twist and turn. They stick to straightforward rules like cut losses quickly and let winners run. The takeaway is clear. Don't let complexity fool you. A simple system, executed with discipline, is more powerful than any complicated approach. It gives you the clarity and confidence to stay consistent, because in trading, consistency is what ultimately leads to success. Rewiring your brain for risk. In Your Money and Your Brain, Jason Zweig reveals a powerful truth. Your brain isn't naturally built to handle risk rationally. It either pushes you to avoid risk altogether out of fear, or chases it recklessly for the dopamine rush. This biological wiring, if left unchecked, leads to emotional decisions that can sabotage your trading. But here's the good news. You can train your brain to view risk objectively. Zweig explains that when you face potential gains, your brain releases dopamine, the chemical responsible for pleasure and reward. This can make risky trades feel exciting and almost irresistible. On the flip side, the thought of losing triggers the brain's fear response, making you overly cautious or prone to panic. This emotional tug-of-war clouds judgment and pulls you away from rational decision-making. So, how do you break free from this cycle? Zweig's answer is to reframe risk as a neutral tool, not something to fear or chase. Instead of seeing every trade as a high-stakes event, approach it like a calculated experiment. Small, consistent exposure to controlled risk trains your brain to handle uncertainty without emotional overreactions. Here's how to apply this in your trading. Start small. Take smaller position sizes to desensitize yourself to the emotional highs and lows. Detach from outcomes. Focus on executing your strategy rather than obsessing over winning or losing. Build consistency. By practicing controlled, calculated trades, your brain adapts to see risk as part of the process, not a threat or a thrill. Zweig's core message is simple but powerful. The more you engage with risk responsibly, the more you reshape your brain's response to it. When you stop fearing losses or chasing wins, you develop the calm, objective mindset required to make smart decisions in any market condition. The art of quitting. In Thinking Fast and Slow, Daniel Kahneman exposes a mental trap that ruins many traders, the sunk cost fallacy. This bias makes people hold on to losing positions simply because they've already invested time, money, or effort. The more you're in, the harder it feels to walk away, even when the evidence says you should. But here's the truth. Knowing when to quit isn't weakness. It's a strategy. Kahneman explains that the human brain is wired to avoid losses at all costs. Once we've committed to something, whether it's a trade or a belief, letting go feels like admitting failure. But clinging to a bad trade, hoping it turns around, often leads to bigger losses. The best traders, on the other hand, treat quitting as a tool for survival. They cut losing trades quickly and move on without emotional attachment. Why is this so powerful? Because staying in a losing trade doesn't make it a winner. The market doesn't care how much you've invested. Your job is to protect your capital. When you hold on to a bad position, you're not waiting it out. You're tying up resources that could be used for better opportunities. Here's how to master the art of quitting. Set clear exit rules. Decide in advance when you'll cut losses. Don't rely on hope. Detach emotionally. View each trade as a business decision, not a personal one. Reframe quitting. Cutting a loss isn't failure. It's freeing up capital to find better trades. Kahneman's insight is clear. Smart quitting isn't giving up. It's making room for better moves. The traders who thrive in the long run aren't the ones who fight every battle. They're the ones who know when to walk away. Building emotional endurance. In Enhancing Trader Performance, Brett N. Steenbarger compares trading to a high-stakes performance sport. It's not just about skill, it's about building emotional stamina. Just like elite athletes train their bodies to handle pressure, successful traders train their minds to stay steady through the ups and downs of the market. Without emotional endurance, even the best strategies fall apart when the heat is on. Steenbarger emphasizes that trading is a mental marathon, not a sprint. It's easy to stay calm when things go well, but how you react during losses or uncertainty defines your long-term success. Emotional endurance isn't something you're born with. It's a skill you can develop through deliberate practice. Here's how you can start building it. Simulate stress. Practice trading under pressure. Use paper trading or small, real money positions to expose yourself to emotional discomfort. The more you face it, the stronger your response becomes. Review setbacks. After every trade, especially the losses, analyze what happened without judgment. What triggered your emotions? How did you respond? This self-awareness helps you grow. Stretch your comfort zone. Regularly challenge yourself with new market conditions or strategies. Pushing your limits, bit by bit, expands your emotional tolerance. The goal is to train your mind to stay calm and focused, no matter what the market throws at you. Steenbarger's message is clear. Emotional endurance separates amateurs from professionals. When you can handle the emotional grind without breaking down, you give yourself the power to stick to your plan, think clearly, and make better decisions over time. The myth of intuition. In The Hour Between Dog and Wolf, John Coates, once a trader, now a neuroscientist, shatters a popular belief in trading. Your gut instinct isn't as reliable as you think. While intuition feels powerful, Coates reveals that it's often driven by biological reactions, especially stress hormones like cortisol, that can cloud your judgment in high-stakes situations. Here's the problem. Under pressure, your body's chemistry takes over. When the market swings wildly, cortisol floods your system, triggering fear and hesitation. On the flip side, a winning streak can pump you full of testosterone, making you feel invincible and prone to reckless decisions. In both cases, your gut feeling isn't wisdom. It's a biological reaction that often leads you astray. Coates argues that professional traders don't trust their feelings. They trust data and rules. Emotions are unreliable, especially when money is on the line. The more intense the market conditions, the less you should rely on intuition, and the more you need a systematic approach. Here's how to protect yourself from the intuition trap. Stick to your rules. Predefine your entry, exit, and risk management strategies, and follow them no matter how you feel. Track your decisions. Keep a journal to spot patterns in your emotional responses and identify when feelings are leading you off course. Pause before acting. When instincts scream at you to jump in or out, take a breath and double-check the data before making a move. Coates' message is clear. Intuition may work in everyday life, but in trading, it's often a trap. Successful traders don't rely on feelings. They rely on discipline, data, and a repeatable process. When the market pressures you, your system, not your gut, is your strongest ally. The discipline of self-talk. In What I Learned Losing $1 Million, Jim Paul and Brendan Moynihan deliver a powerful lesson. Your internal dialogue can make or break your trading career. Paul's downfall wasn't just bad trades. It was the way he talked to himself while making them. When traders let their thoughts run unchecked, rationalizing mistakes or chasing wins, it becomes easy to ignore reality and spiral into bigger losses. Here's the danger. Self-talk shapes your decisions. When you tell yourself, I'm due for a win, or the market has to turn around, you're not following logic. You're letting emotions control your actions. This mindset keeps you stuck in losing positions longer than you should be. Paul's story is a clear warning. The moment you start justifying bad decisions instead of questioning them, you're on the path to disaster. The key to avoiding this trap? Monitor and redirect your self-talk. Instead of emotional statements, use questions that keep you grounded and objective. Here's how to do it. Challenge emotional thoughts. When you catch yourself thinking, I can't lose again, stop and ask, what does my plan say? Stay process-focused. Replace outcome-driven thoughts like I need to win with am I following my system? Create mental checkpoints. Before entering or exiting a trade, pause and ask, is this decision based on my strategy or my feelings? Jim Paul's experience shows that losing control of your self-talk means losing control of your trades. By keeping your internal dialogue disciplined and tied to your plan, you stay focused, objective, and in charge, no matter how emotional the market gets. The confidence paradox. In Trade Like a Stock Market Wizard, Mark Minervini highlights a crucial psychological trap: the fine line between confidence and overconfidence. According to Minervini, true confidence in trading doesn't come from bold claims or gut feelings. It comes from thorough preparation and mastery of your system. The paradox is this: Too much confidence leads to reckless mistakes, while too little confidence stops you from taking necessary action. Overconfidence is dangerous because it blinds you to risk. When you believe you can't be wrong, you ignore warning signs, hold losing trades too long, or take positions without proper analysis. On the other hand, underconfidence paralyzes you, making you second-guess solid setups or exit too early out of fear. Both extremes destroy long-term success. Minervini's solution? Build quiet confidence through preparation and discipline. Confidence isn't about how loudly you believe in a trade. It's about how well you've tested your system and trusted over time. Here's how to develop that kind of confidence. Master your process. Know your trading plan inside out: entry, exit, risk. Confidence grows when you've tested your system across different market conditions. Track your performance. Keep a trading journal to review what works and what doesn't. Real confidence comes from proven results, not assumptions. Stay humble, stay curious. No strategy works 100% of the time. Be confident in your system, but open to learning and adjusting when necessary. Minervini's message is simple. Confidence should be quiet and earned, not loud and assumed. The traders who succeed aren't the ones boasting. They're the ones who trust their process because they've put in the work. And that's it for today's Trading Psychology Insights. Each of these lessons, whether it's mastering your self-talk, embracing uncertainty, or building quiet confidence, can transform the way you approach the market. Remember, trading success isn't just about strategies. It's about having the right mindset to handle wins, losses, and everything in between. If you found these topics helpful, hit the like button. It really supports the channel. And don't forget to subscribe so you never miss future videos packed with practical trading wisdom. Also, I want to hear from you. Which topic resonated with you the most? Drop a comment and let me know if there's a book or a concept you want me to cover in detail. I'm always reading and creating content based on your feedback. Thanks for watching. Keep learning, stay disciplined, and I'll see you in the next video.